Okay, good evening, everyone. Welcome to our webinar this evening. First of all, thank you so much for joining us. Just to share, we are live both on Zoom as well as StashAway's YouTube channel. So thank you so much for joining us. So just a little bit of housekeeping before I proceed. Throughout the webinar, if anybody has any questions, please feel free to use the Q&A button below if you're on Zoom. And if you're on YouTube, there will be a little chat box on the right-hand side of basically what you're viewing. So please feel free to also use that chat box to share any questions that you might have for our panelists, and we will get to it toward the end of the webinar. So first of all, let me start by introducing our panelists to the audience tonight. First off, we have Wai Hoong, who is the Senior Portfolio Manager at Nikko AM. Next up, we have Tochia, who is our co-head of fixed income at Lion Global Investors. And last but not least, we have StashAway's very own Justin, who is currently a macro research analyst in the CIO office with us. So my name is May. I am currently the head of client experience at StashAway, and I will basically be assisting to moderate this panel. So again, welcome everyone to our Cash is King, but is it really a webinar this evening? In today's current climate, we get more and more questions from our clients asking what they should do with their cash, more so now, I guess, in the current macroeconomic environment. So cash may appear to be liquid and safe, and has for a long time been seen as the best asset to hold on to, especially when markets are a sea of red. But the reality is that the purchasing power of your cash decreases with time due to inflation. So while this effect may not have been so obvious over the past few years of low inflation, we're definitely seeing inflation at multi-year highs across the world. It's also hitting closer to home now, and we definitely see this reflect in rising energy bills, rising grocery prices. That said, it's not all doom and gloom. The good news is that there are low-risk options available in the market for you to stash your spare cash for yield. Here in Singapore especially. So we're here today to look at what you can do with your cash and how to choose the best option for yourself. Hopefully we will be able to shed some light on this matter this evening. So moving on, this is just a brief outlook of the agenda for this evening. So we will have a Q&A session toward the end. So again, just a reminder for our viewers on Zoom, if you have any questions, please feel free to type them out in the Q&A box below. For our viewers on YouTube, please feel free to basically use the chat box on YouTube. So to start us off tonight, we will be sharing a brief overview of the current macroeconomic environment. So I will basically hand it off to Justin, who will be taking us through some insights.
Sure. Thanks, May. Hi, everyone. Good evening, and thanks again for joining us tonight. As May mentioned, my name is Justin Jimenez. I'm a macro research analyst at StashAway based in Hong Kong. I'm part of StashAway's investment team where I work with our co-CIOs, Freddie and Stephanie. So tonight I'll be giving an overview of the current macro environment to help frame the discussion later with our fund managers from Nikko AM and Lion Global Investors on why cash management tools can be helpful in this current market environment. So let's jump right in. Next slide, please. So to put it simply, 2022 has been a shocking year for the economy and for markets. And you might ask why shock here is underlined. So a bit of nerding out to start. A shock in macroeconomics is basically an unforeseen event that has a material and a widespread impact on the economy. And this year we had a number of those. So first it was the unexpectedly persistent inflation, then central banks rapidly hiking interest rates to deal with that inflation, then rising recession risks as rates rose, and all contributing to a major market shock. And so I'll go through each of those. Next slide, please. So first, the inflation shock. Here I'll focus on the US as an example, but somewhat similar dynamics are at play in many countries around the world. So last year, I put here that many central banks had dismissed rising inflation as quote unquote transitory. That meant that they thought that short-term factors were pushing up inflation and that it would soon go away. So the shock is that inflation has been much more persistent than they expected. Inflation continued to rise throughout the year, as you'll see on the far right-hand side, that white line there. It peaked at around 9.1% year on year in June, and the latest reading for September was about 8.2%. Obviously, that's still very high, and the highest since the 1980s, in fact, if you look to the left-hand side of that chart. And as referenced, the US Federal Reserve's target for inflation is 2%. So here it's also, I think, important to distinguish between this white line and this blue line. So headline inflation is this white line and core inflation is the blue line. Headline inflation includes everything that a consumer can buy, from a new smartphone or to gas for your car or to a meal at a restaurant. And as you can see, that's started to come down. Core inflation, however, that blue line is still trending upward. As of September, that core gauge was about 6.6%, and also at a 40-year high, as you can see. And that's what the Fed is particularly worried about, and I'll show you why in this next chart. Next slide, please. So core inflation basically strips out volatile categories like food and energy. So the prices of these items tend to swing more than other items that an average consumer would buy. And as you can see here, what's rising now is services inflation, which is the orange line. This tends to be driven mostly by, largely by labor costs, which are the stickier kind of inflation that the Fed and other central banks are really worried about. And they're worried about this because it could lead to what economists call a wage price spiral, where increasing wages lead to higher prices, which feed back into higher wages and then higher prices. And that's what led to the runaway inflation that we saw in the 1970s. And this is exactly what the Fed is trying to prevent. Next slide, please. So against that background of shockingly high inflation, the Fed needed to act really quickly to cool the economy and tame it. And this brings us to our second shock, the rate shock. This chart essentially shows the Fed's recent interest rate hiking cycles going back to about the late 1980s. And as context, when the economy is strong and inflation is elevated, central banks like the Fed increase interest rates to make borrowing money more expensive for consumers and for businesses to help slow things down a bit. Typically, this happens over a longer period of time. So the horizontal axis shows how many months it's taken the Fed to raise rates from the start of the cycle to the top of that cycle. And this vertical axis shows the change in the Fed funds rate, which is the Fed's benchmark interest rate in basis points. And a basis point is basically 1/100th of a percent. So 100 basis points is 1 percentage point. So I guess what most important here is this yellow line, which is the most recent hiking cycle. Over just the past 6 months or so, the Fed has raised interest rates by 3 percentage points so far. And this is by far the fastest and most aggressive pace in recent history. And that's why many people think that this is very likely to tip the US economy into recession. Next slide, please. Which brings us to our next shock. With the Fed rapidly rising rates, that's brought forward expectations of the timing of an eventual US recession. So this chart here is from the economic research team at Bloomberg, and at first it might look like a jumble of lines. Basically, these are all various economic models and measures that are seen as leading indicators or predictors of recessions. And the gray areas there are show past recessions, like the financial crisis, the dot-com bubble, the COVID crisis. What I want to point out here is at the far right end of the chart. So basically, 3 of these 4 measures have jumped significantly in recent months, with Bloomberg's measure at 100%. Odds of a recession. And that basically means that a very sustained downturn in the US economy could be very near. And if you go to the next slide, we'll see that it's not only the US economy that's under stress, but the global economy as well. So these are forecasts from the IMF on global growth for next year as of their October forecasts. The main takeaway here is that it's lowered its forecasts even more than its last update in July. But also, both of these forecasts are well below the average of the past 2 decades. That on the left chart there, the average of the past 2 decades is that sort of red dash or dot. So there are a number of reasons behind the slowdown across the world, in addition to the US hiking interest rates, which tends to have ripple effects across the world. In Europe, for example, which the IMF is projecting to slow to 0.5% growth next year, they're facing huge challenges from energy costs and a war in their backyard. In China, which is expected to have 4.4% growth and is well below its average of more than 8% over the past 20 years. There, basically, its COVID zero stance and a downturn in the property sector are really what's weighing on their economy. And if you move to the next slide, that basically takes me to the last shock of the series, the market shock. So given all these forces, and in particular the Fed's focus on bringing down inflation through its interest rate hikes, markets have seen a deep and a broad-based decline this year. I should note that this is a very rare occurrence. So in the last 40 years or so, we haven't seen such a synchronized drawdown in both stocks and in bonds. As you can see from this chart, global equities are down by 25% in US dollar terms for the year to end September. That's the far right bar, a blue bar on the right, sorry, and global bonds are down 21%, and that's the red bar. If you look at the US, the picture is very similar. Their data goes back even further, and there in the past century, 2022 is one of just 5 years that both large cap equities and 10-year treasuries have posted negative returns, and actually the only year that both have posted double-digit declines. So based on that, looking forward, what to expect? Basically, high inflation and still resilient economic data in the US means the Fed may need to continue pressing ahead with its hikes and potentially even bring them higher than they previously projected. And that would mean more bad news for markets in the near term. Okay, so let's take a breather and let that all sink in. A lot has happened in the past year in the markets and in the broader economy. And if we go to the next slide, I'll just quickly go over, switching gears, what you can do with your money in this tough macro environment before turning it over to me and our guests here. So next slide. Great. So before I go into what you can do with your cash in the near term, I think it's important to remember that for money that you don't need right away, it still pays to remain invested in a diversified portfolio for a number of reasons. Firstly, if your risk appetite and your investment horizon allows for it, you could consider this downturn to be an opportunity to buy at a cheaper price. Secondly, it's almost impossible to time the markets. As you can see the infographic on the right, market recoveries, they can happen really quickly and they can miss it if you stop, and basically you can miss it if you stop investing. Moving on to the next slide. But I guess there are a few considerations for what you can do with your cash in the near term. So in general, it's a good rule of thumb to have about 1 to 2 months worth of expenses in your current account. Any more than that, and you're basically losing your cash's value to inflation, as current accounts tend to earn very little interest. For your emergency fund, which should have about 6 months worth of expenses, we'd recommend keeping it in a liquid interest earning account. This can be a savings account, a money market fund, or any other low risk liquid investment. Essentially, you just want to be able to access your money when you need it. You want to guard against losses in the principal, and you also want to put your money to work for you. In the next slide, we can look just briefly at some of the options that are available in Singapore. I won't go into each in detail, but I think the main takeaway here is that there are a number of options, each with its own pros and cons. But ultimately, leaving cash in the bank or even in instruments like fixed deposits can often mean lower returns, lock-in periods, minimum investments, and other conditions. And if we move on to the next slide, here at StashAway, we have 2 cash management solutions to help you grow your cash and give you a steady stream of income. Those are Simple and Simple Plus. Both have no minimum balance, no cap on the balance that can earn returns, no lock-in period, no restrictions on withdrawals or transfers. Currently Simple, it has a projected rate of 2.2%. Those details are on the left side. And Simple Plus currently has a projected rate range of 3.6 to 4.1%. Below, you can also see the breakdown of our underlying funds with our fund managers here from Lion Global and Nikko Asset Management. Next slide, you will see basically what goes into a cash management portfolio. These portfolios, they invest in underlying funds that range from cash funds and money market funds to shorter duration bond funds. The takeaway here is that the lower the maturity of the underlying assets, the lower the risk, but also the lower the return potential. So for very low risk products like StashAway Simple, you'll find funds with very short maturities like money market and ultra short duration bonds. But as you go down this table, you'll see that the duration of the underlying securities increases, that makes portfolios slightly more sensitive to things like interest rate movements, economic conditions, which gives them potential for higher returns. And these are what make up the underlying securities in Simple Plus. As a bit of sort of context, what we do at StashAway is select funds to optimize the risk-reward ratio of the entire portfolio. And to do that, we consider things like credit rating, currency risks, fund size, and historical performance. And lastly, we only choose high quality investment grade funds with proven track records. If you move on to the next slide, I'll just conclude. As I mentioned earlier, Simple and Simple Plus are just one piece of your investment pie. At StashAway, we have a number of solutions to help you grow and build your wealth. And now I'll pass back to May, who'll be speaking with our fund managers from Nikko Asset Management and Lion Global Investors to dive even deeper into this topic. Thanks, everyone.
Thanks, Justin. So I hope that was insightful for everyone. So again, as a reminder, if you do have any questions, please feel free to post them in the Q&A box on Zoom as well as the chat box on YouTube. So moving on, so we'll just start with a very brief discussion with our fund managers at Nikko Asset Management as well as Lion Global Investors. As Justin mentioned, here at StashAway, we have two cash management portfolios, which is Simple as well as Simple Plus. So ultimately, in Simple, the product basically consists of Lion Global Singapore Money Market Fund and Lion Global Singapore Dollar Enhanced Liquidity Fund. So I'll direct the first question to Toh Chia. Could you just give our audience a brief overview of what the funds are and essentially what the difference between the two are?
Sure. Thanks, May. Good evening, everyone. So before I go into the funds, I just want to make a comment about the macro picture which Justin painted. Thanks, Justin, for giving us a background to that macro environment. As Justin mentioned, remember the chart with the Fed hikes, right? So the Fed has been hiking aggressively recently, and I just want to add that the market, in fact, the Fed and the market has priced in further hikes, right? And what happens is that as a result, interest rates have risen, the bond yields have risen, right? And in that regard, when our funds invest into the bonds, we are investing at higher yields, right? So not everything is really doom and gloom, right? Because all this environment which Justin describes basically means that the rates are now more attractive for investors, for the funds and for end investors like yourself to be able to participate in the higher yield, right? So if you flip it the other way around, you're actually given a chance to invest at a better yield than what it was, let's say, a year ago, right? And the second point I want to mention is that Justin mentioned about the potential recession risk, which is very real, right? I mean, hiking rates at such fast pace does pose a risk to the global economies. And if a recession does occur, that's actually a good thing for bonds, right? Because you're not investing at higher yield. In times of recession, the Fed has to do the opposite, right? They have to cut rates, and when they cut rates, that's actually good for bonds. Now, coming back to the question about the product, so we have two funds under the product Simple. Our money market fund, the Lion Global Money Market Fund, and our enhanced liquidity fund. Now, both are short-dated funds with very high quality. Now, the money market fund has a duration of about 0.3 years, and we invest in very high quality. The average rating is A+. If you move a little bit along the spectrum, we move a little bit to the right. The enhanced liquidity fund has a slightly longer duration. It has a bit more flexibility. The duration goes up to 0.5, 0.6, and the rating goes up to single A. Right now, this is the average credit rating. Now, when we allow ourselves to buy a little bit more longer dated with a little bit more credit risk, then the yield gets better, right? So both these funds gives us yield of between 2.2 to 2.5%. That in a nutshell is what the two funds are about. Back to you, May.
Cool. Thanks so much, Toh Chia, and also thanks so much for sharing brief insights into the market. So moving on to our StashAway Simple Plus product. So essentially, Simple Plus comprises of again Lion Global Singapore Dollar Enhanced Liquidity Fund, as well as Lion Global Short Duration Bond Fund. But in addition to that, we do have Nikko Asset Management's Shenton Short Term Bond Fund. So next, I would like to invite Wai Hoong to the floor to just sort of give us a brief overview of the fund.
Hi, thanks, May. Talking about fund, this if you compare to what just further on what Toh Chia had mentioned about moving the spectrum from money market fund. So the short duration bond fund in general, I mean, there's no fixed and hard definition for short duration bond fund. Basically, if you essentially for any short term or short duration bond fund, basically that tend to buy bonds up to 5 years for maturity, keeping the average portfolio duration between 1 to 3 years or so. So before moving on to the funds, right? I mean, just to share with the audience, right? Got a bit bear in mind when you look at this across the short duration bond fund in the market, in the sense that the average duration could be low, but you have to look at how the construct of the portfolio, whether is it barbell, some of the manager or some of the fund out there are basically taking a barbell strategy, meaning that you're buying the short and the long end, but the average duration is still come to a very short 1 to 3 years. So that will subject investor to the duration risk, which is exactly what the market is facing right now on the outracing environment. Also, in terms of the credit quality, also in terms of the are you buying just the high grade? Are you buying up are you going down the structure? These are little things that investor got to bear in mind. That how one short term duration bond fund versus another. So, but essentially, I say, you tend to any short term bond fund or short duration bond fund is tend to provide a basically investment that's less subject to the durations risk.
Okay, thanks so much, Wai Hoong. So I mean, a question to both, but Toh Chia, please feel free to answer first. So given the current economic environment, what are the foreseeable impacts on Lion Global's funds?
Right. Now, for the funds that we mentioned earlier, as you know, yields are now higher. The way our funds are structured is, especially for very short duration funds, right? I mean, if my fund has a duration of, let's say, 0.3, it means that, you know, every 0.3 years, my fund gets to roll. But in reality, what happens is that the maturities are all spread out, right? So, for example, every other week, I have something maturing. Now, if I have something maturing, I get to reinvest my proceeds in the current higher yield, right? So what you will see is that over time, you see that the yields of a fund will get higher to reflect the higher interest rate environment, right? So while we do see whatever yield that we publish, even at the simple your product level, what happens is with the passage of time, you would expect to see the yields increase. And this really reflects the current environment we are in. So that's the situation that we're in. So we do expect that the yield of the simple to slowly accrete higher over the passage of time. And we're not talking about a very long horizon, right? Because I mentioned that the durations of the two funds which simple is invested in are very short. So that's the way investors can benefit from the current high interest rate environment.
Okay, thanks so much, Toh Chia, for that outlook. Wai Hoong, is there an outlook on your end for Nikko AM's fund?
Sure. I mean, before talking about that, right? Looking at the, I think the key questions that investors may be asking in terms of the current, like the backdrop that Justin presented earlier on, in terms of the volatile market that we have been seeing thus far in 2022, right? So if you break it down in general, what are the risks that the investors are basically facing? One is your duration risk, a very sharp rising interest rate environment. You have your economic. Just now you mentioned about the probability of recession. In that case, the credit cycle, economic cycle, credit cycle that investor may be facing. And the other one is basically your FX risk, right? And in terms of FX risk, as you know, the dollar has been very strong since like the quarter of last year. I think these are basically what investors essentially in the credit in the fixed income are facing. So how is our fund able to provide a comfort or a shield for investor in terms of these key main area of concern that we have highlighted just now? So in terms of duration risk, very similar to what Toche mentioned. For the short duration bond fund that we are managing, the portfolio average duration is just about 1.1 year. But I'm just looking at just this 1.1 year. If you look at the construct of the portfolio, about 30%, more than 30% of the portfolio are actually matured within the next 1 year. And this fund has been always practicing a very laddered maturity approach for the fund, meaning that every month there will be proceeds that actually coming in, maturity coming in. And similar to what Toche mentioned, in this uprising yield environment, every maturity proceed you're able to reinvest in a higher prevailing yield. So that's how we shield from the uprising or benefit from the uprising yield environment. In terms of the credit cycle, economic cycles, I think that's where you look at the credit spread, you look at the credit standing of the portfolio. Now, the average portfolio rating for a fund is A-. But not just that. I think most importantly, in terms of the holdings, right? This fund does not go down the capital structure. We don't hold any perps. I think the maximum hold is in terms of capital structure, we move down to is the bank subdebt, and that give the actual fixed a certain maturity to every holdings that we hold in the portfolio. That's on the credit per se, and in terms of the FX, this fund doesn't take any FX risk. Don't participate in any local currency holdings, and if it's all these DM holdings are basically hatchback to Singapore. So investor does not need to worry about the FX risk. So in that sense, this slow, stable carry and returns are basically helping this fund to actually having a very predictable return out there. And we look at how year to date, how the US Treasury short end 2 years to 5 year for the Sing SGB move, no 2 year 5 year. Both have both market when the 2 years have basically in terms of return have returned almost as negative 6% on the 2 year and negative 10% on the 5 year. But you look at the fund performance, is actually much better than where this risk-free rate has performed year to date, and that means that we have all this our return and carry are actually basically provide a return more than better than the risk-free rate.
Okay, so if I'm understanding this correctly, essentially both funds, while contain very different underlying perhaps bonds, it's still very well protected against the headwinds that are coming, right? Whether it's FX, Wai Hoong, as you mentioned, or any sort of credit risks as well, that we're probably seeing in the market. So ultimately, if an investor is choosing an option on where to invest their cash right now, how should they approach this mindset? What are some of the key criteria you advise one to look out for in this instance? Tocha, shall we start with you?
Sure. I think we're in an interesting time. Again, given the backdrop Justin painted, we're in an environment where interest rates are much higher than what it was before, to the extent that people are suddenly they just woke up and realized, yields are so much higher. So in a sense, they do have a few choices that they can make. But I would say the first thing that you have to ask yourself is whether is there a need for liquidity, right? Meaning, do you need the money next week, or can you keep it locked away for 1 year, right? That presents a different choice to investors. So obviously, if you have a long horizon, you have more things to choose from. But then on the other hand, if it's something that you do need to liquidate in, let's say, a few days' time, then you might want to consider something that gives you daily liquidity, right? As in this case, the Simple or Simple Plus does provide. Like I said, I know right now the Singapore government bond yields are looking attractive, but then you have to bear in mind, whether or not it provides you that liquidity given to you. So for today, I think the product that we're talking about, we provide daily liquidity. In a sense, that actually comes at a cost, right? Because nothing's for free. But therein lies the trade-off, right? If you do need liquidity, then we do have a product at hand for investors to consider. And like I said, when we are able to provide the daily liquidity, it's not a magic, right? There's a cost involved in giving investors daily liquidity. So that is the trade-off, right? So if you want to compare against just on yield alone, you have to factor in the liquidity need of your investments. Maybe I'll stop here for now.
Thanks, Toh Chia. Wai Hoong, would you have anything to add to that?
No, I think I concur with Toh Chia. I think in terms of the various product that what Justin had presented in terms of the alternative for cash management, right? I think the key thing is liquidity, right? And also about flexibility. If you invest with a fund manager or buy a fund like this, like us, right? It basically the manager is able to react. Beside the flexibility, the facilities that are given to the manager, I think while you're locking in if you're a fixed T or government a 6 month T-bill, you are really looking at that fixed rate. But in terms of how basically the funds are being managed on an ongoing daily basis, right? And that can be deployed at a certain level that is we can seize the opportunity and seize and invest in a better level that at the prevailing market rate than compared to what you're locking. Take for example this 6 month T-bill. I think has been widely published in the press locally, given how effective it is. But you look at the trend in the past 1 month or so, every auction the yield has been moving up. Right? That means that if you had bought this 6 month T-bill start of the year, you actually was off in a sense, right? But you can, because this 6 month T-bill will only mature in 6 months, but you cannot benefit this outward raising trend that have been seeing even in the 6 month T-bill issued by the government of Singapore. So flexibility is one thing, but able to capture this upward raising trend, I think is also very important.
Okay, so so far we've been talking a lot about, currently in this environment, if we look toward America, the Fed has been very aggressively hiking rates. But ultimately, how might bonds perform? How might bonds of this duration more specifically perform if the Fed, just decides one day to just start cutting rates?
Right. So as you mentioned, the Fed has been aggressive in hiking rates, and as I mentioned earlier, the market is really pricing in another at least 175 basis from now to second quarter next year, right? So we're having a meeting in November where market is pricing 75 basis, and then probably another 50 in December, and on top of that, another 50 in first quarter of next year. That brings us roughly to close to 5% Fed fund rate, and that in our mind is a pretty high level. So that's it. May, you mentioned about what happens if Fed cuts. We don't really need Fed to cut. You just need them to stop hiking rates, right? That's enough for the bond market to be cheerful about. And as you know, it can't be that the Fed just keeps on hiking rates, because the economy is feeling the pinch, right? So at certain point, they have to stop hiking so aggressively. And financial markets being what they are forward-looking, right? So the market is always checking on where is the pain point, at which point does it becomes too painful. And as it is now, we suspect that we are very close to that. And when that happens, the longer duration funds will start to benefit, right? So like Nikko's Wai Hoong's fund will start to benefit because the duration is longer. And likewise, we have a short duration bond fund which is slightly longer than the ultra short funds. So in that environment, when the yields start to turn down, then you see the slightly longer duration funds starting to benefit from the repricing of interest rate environment. Yeah, maybe Wai Hoong want to add on to this.
Yeah, I mean, I do agree with what Koche said. Right? I mean, don't really need Fed to hard. You just need a pivot, and the market will just really substantially, given how aggressive the market has been so far. And also, again, talking about the flexibility, right? Whether my fund or Koche fund, right? The durations I think we have been very defensive over this past year or so. And again, the flexibility is for us to, when that happens, right, we can always redeploy whatever we have in the cash or very short end of the curve to the longer end, right? From a 1 year bond, we can always buy a 3 year or 4 year bond. And that's where in terms of the rally you benefit from the rally on durations. So again, that you have invested the bet, basically where wait a little bit between the flexibility or potentially able to seize the market by investing via funds.
Okay, thanks. So ultimately, also, given the one feedback that we do get from a lot of our customers is that they're extremely fearful of the market. So for a lot of individuals, they would rather hold on to cash than really investing it, even in something safe like a money market fund, for example, right? Or relatively safer at least. So we actually have one question. I guess it will benefit for a bit more explanation. And the question is, can I lose my capital if I invest in money market funds? Understandably, in this world, there's no such thing as guaranteed returns or guaranteed capital in any sort of investment vehicle. But what would you sort of say to this individual in the sense that, in the bigger scheme of things, grander scheme of things, ultimately putting your money towards something like a money market fund will be more beneficial versus just holding it in, say, savings and current accounts?
Right. Okay, thanks for the question. So yes, theoretically, you can possibly lose or rather have capital losses in a money market fund. But having said that, in Singapore, if you were to call a fund money market fund, the MAS has certain criteria that we need to abide by. You can't just call any fund money market fund, right? So in our case, the fund's minimum rating is A-, right? So anything we buy must have a minimum rating of A-. That's one. We have other restrictions like we have country cap. We need to keep a certain percentage in cash. Duration cannot exceed a certain number of years. So there are, investment parameters put in place. And of course, like I said, MAS has a certain requirement we need to abide by. Now, naturally you compare yourself against putting your cash into a bank, either 2 years. You put a deposit in the bank that's guaranteed. Now, bear in mind, you're bearing the risk of the bank, right? And not all banks are, rated A. So it's something you have to bear in mind. Then the next point I'll bring up would be that liquidity question, right? If you place your money in the fixed deposit, you'll be locked out. Is it 12 months, 24 months? A fund has daily liquidity. Yeah, so these are the key difference, but I need to highlight for purely compliance reason, right? A money market fund does take credit risk, right? So when I mentioned A minus, so we're talking about taking credit risk of bonds that the fund invests in, right? So it's not right actually to compare a money market fund against a fixed deposit.
Thanks, Sochia. Thank you so much for the insights. Just kind of segueing a little bit. Ultimately, we also have had some users reached out to us saying that they also would prefer to put their money in treasury bills as a cash management option. So ultimately, how does treasury bills compare to money market funds?
Yes. So again, back to my point earlier, if I were to buy a 6-month T-bill, for retail investors, it's very hard for you to get out after, let's say, 3 months, right? Most likely you have to let it mature. And then, assuming you don't need the money and you want to reinvest, you reinvest at whatever rate is offered at that point in time. If you buy a money market fund, you get daily liquidity. Now, our money market fund actually does invest into T-bills, right? So in a way, by buying the money market fund, you do get indirect access to a T-bill, except that at the fund level, we are spreading out the maturity, right? So as I think Wai Hoong made this point earlier, if you buy a T-bill, say 6 months ago, you would have locked in whatever rate you had then. Right, but buying into a fund, you do get to participate in the fund as the fund reinvests its cash into the current rate of the T-bills, right? So in a way, you are spreading out the timing of your investments, if I could put it that way.
Thanks, Sochia, for your insights. We have a question for Wai Hoong. So given Nikko Asset Management's funds exposure to basically short-term bonds, how essentially might this be impacted by the volatility we are seeing in the current macroeconomic environment?
I think that I mentioned just now in terms of how this fund able to fare during this environment. Right? Remember I mentioned about how the fund is positioned against the uprising interest rate, against the potential recession risk and the down cycle in the credit market, where we don't invest in high yield. We only hold short-dated credit, and in a recessionary environment, the tendency is that your risk rate will flatten, but your credit curve is tend to be steepened. So having a short holding a credit at the shorter end, that prevent this potentially having a short spread durations. You will not unless it's a deep recession, you will not be too worse off. Then also about the FX, I think that has been covered in the sense that this fund does not manage and does not take currency exposure. So all in all, I think like I mentioned, what we have seen out there in terms of the market risk, I think this fund is positioned nicely against all these potential risks that we are seeing in the market.
Okay. And I know earlier on you did share a brief market outlook. But ultimately, a question that we also have from the floor is, what is the market outlook for short duration bonds in the next 12 months? Is there a potential for bond prices to fall further?
Very much. If you look at the component of a bond price is essentially make up of two big components, right? One is your risk-free rate, and one is your credit spread. Now, in terms of the risk-free rate, again, this has been touched on quite extensively by Dolce, right? Where the market is actually pricing. I mean, is forward-looking, and right now where it is right now, looking at, let's say, take the Treasury, 2-year Treasury, for example, is 4.2. The Fed terminal rate is around 4.6, but the market is pricing about 4.9% up to second quarter of next year. Now, in terms of the adjustment for the risk-free, we started the year about 70 basis points. Right now, as I mentioned, 4.2. If the terminal rate from the Fed is about right, or even if you take the market expectation, which is 4.9, the adjustment to me is towards the tail end. Of course, finger crossed that we will see some tapering of the inflationary environment. And that means that the sell-off that we have seen in terms of a major correction in terms of the bond prices that we have seen, which is driven by the risk rate, are towards the tail end of the correction. Now then come the credit spread. The short end of the bonds, whether in the Sing dollar bond or the dollar bonds, generally has been behaving quite okay, quite well. That largely because into this recession, by and large, corporates, the Asian corporates are coming into this recession in a pretty good shape. If you look at of course, certain sectors are basically facing some difficulties, but by and large, the shape have been the credit the credit indicator, the health of the high grade corporates, I'm referring to the high grades, are generally quite well in terms of the liquidity, in terms of the leverage. Property may be coming down a little bit, but margin will be squeezed. But the overall health of the short-term high-grade bonds in Asia has been pretty okay. So don't expect a big sharp sell-off in the credit spread per se, like as per in a deep recession. So that means that for next year, in terms of take a 12-year horizon, I mean, you can't predict what day on day, one-year basis, but you're taking a 12-year, 12-month horizon. I think the whatever you short-term 1-year short-term bonds are trading at a 5%. I think those are decent holdings for anyone to basically want to have a good carry, less risky, but kind of holdings that one want to have.
Okay, thanks Wai Hoong for your insights. First of all, thank you so much to Wai Hoong and To Chia for joining us tonight. Before we move on to end this webinar, I'd just like to kind of give a brief overview of earlier on we had a poll question. And one of the questions that we had was, how long are you thinking to invest your cash for? And we had a really good split of answers. Essentially, some people, well, it is quite even across. There were a bunch that said 6 months, another bunch that said 12 months, and another bunch that said more than 12 months. And ultimately, for some of the individuals, some of the main fears they have about investing in the current market is they're basically fearful of losing money. Fearful that your funds are not insured. And of course, the biggest one for all of us, inflation. But ultimately, if there's anything we can take away from our webinar today, and for what To Chia as well as Wai Hoong and Justin has shared with us, is that, in the current environment, yes, it is unpredictable, but there are definitely ways for you to stash your money in, definitely to grow it. Ultimately, keeping it in the bank might not be the best option. Having it locked up somewhere might also not be the best option, but obviously that also depends on your own liquidity needs. Yeah, and honestly, every bumpy market, there will always be an end. So from us to you, just hang in there. We're all in this together. But yeah, Wai Hoong, To Chia, any last words for our audience?
No, I just agree with what you said, that sometimes not doing anything can come at a cost. So something to think about.
Thank you. All right. And then with that, I would like to also thank everybody who has joined us this evening. And hopefully we'll see you soon. If there's any questions, please feel free to reach out to StashAway support at support@stashaway.com. And thank you so much and enjoy the rest of your evening.
Thank you, May.
Thank you.
Thank you.